Hello, friends. Welcome to Weekly Recap China Edition. We follow all the news so you don't have to. Today's topics are Evergrande liquidation, workers are accepting less pay, clean energy investments soar, and $6 trillion market rout. But we start with a quick look at the financial markets. The Shanghai Composite sank 1.83% to close at 2,831 on Tuesday, extending losses from the previous session as investors continued to grapple with the fallout from Chinese property giant Evergrande's liquidation order. China's stock and bond markets are signaling to policymakers that more steps need to be taken to revive investor confidence. Stocks fell for a third day, while government bonds dropped to their lowest level in more than 2 decades. The liquidation of debt-ridden China Evergrande Group has intensified concerns about the embattled real estate sector. Earnings from major companies are disappointing and geopolitical risks are resurfacing. Investors are pessimistic and believe that more stimulus is needed to address the current deflationary environment. The slide in equities shows that investors are likely to sell unless Beijing takes bolder steps. The poster child of China's property crisis is no more. But the mess that triggered the downfall of China Evergrande is far from over. On Monday, China Evergrande Group received a liquidation order from a Hong Kong court, starting the process to divide up the biggest casualty of a property crisis that is disrupting the world's second largest economy. The ruling on Monday is the latest development in a story that saw Evergrande accumulate over $300 billion of debts during China's debt-driven property boom, before becoming the symbol of a market downturn that shows little signs of improvement. On Monday, the company's value was only $275 million before trading in its shares was halted, representing a decrease of more than 99% from its peak. Evergrande's collapse is by far the largest in a crisis that has negatively impacted China's economic growth and resulted in a record number of defaults by property developers. Now that liquidation is official, let's have a look at how it all got to this. In the mid-1990s, in the bustling city of Guangzhou, China, a young entrepreneur named Zhu Jiayin had a vision. With a passion for real estate and a keen eye for opportunities, he founded Evergrande Group in 1996. At that time, the Chinese real estate market was just beginning to open up, and Zhu saw immense potential for growth. Evergrande initially focused on residential real estate development in Guangdong province, delivering high-quality properties at competitive prices. The company's commitment to quality and affordability struck a chord with Chinese homebuyers, and it quickly gained a reputation for delivering on its promises. As Evergrande's reputation grew, so did its ambitions. The company began expanding its operations beyond Guangdong, venturing into other major cities across China. Zhu Jiayin believed in the adage "bigger is better," and he aggressively acquired land for new developments, often outbidding competitors. This rapid expansion earned Evergrande the nickname China's #1 developer. Zhu Jiayin wasn't content with just real estate though. He believed that diversification was key to long-term success. Evergrande ventured into various sectors including tourism, healthcare, and even electric vehicles. The company acquired a significant stake in China's electric vehicle maker, Faraday Future, and announced plans to revolutionize the automotive industry. Evergrande's success was not limited to China's borders either. The company made significant investments in international markets, including the United States, where it acquired prominent real estate assets like the Plaza Hotel in New York City. Evergrande aimed to be a global player in real estate and related industries. Throughout the 2000s and early 2010s, Evergrande's growth was nothing short of meteoric. The company's stock price soared, making Zhu Jiayin one of China's wealthiest individuals. Evergrande's projects dotted the skylines of major Chinese cities, and it was seen as a symbol of China's booming real estate industry. However, with massive growth came massive debt. Evergrande had borrowed heavily to fund its expansion, and it became increasingly reliant on debt financing. By the mid-2010s, signs of financial strain began to appear as China's government started implementing tighter regulations on the real estate sector. Evergrande's vast debt load would eventually lead to the financial crisis that unfolded in the late 2020s, marking the beginning of its fall from grace. As the year 2020 turned into 2021, Evergrande Group found itself on increasingly shaky ground. The debt crisis that had been looming on the horizon for years had now arrived, threatening to engulf the once mighty real estate giant. Evergrande's colossal debt load estimated to be in the hundreds of billions of dollars, was a formidable challenge. The company's finances were stretched to the breaking point, and meeting its financial obligations became an uphill battle. The financial world watched as Evergrande faced one credit rating downgrade after another. These downgrades were a stark reminder of the perilous situation the company was in. Investor and consumer confidence continued to erode. Amid the growing uncertainty, a wave of discontent surged among homebuyers who had invested their hard-earned money in Evergrande properties that remained unfinished. Protests erupted, unlike anything we've seen for many years in China, and a chorus of voices demanding refunds grew louder by the day. China's authorities could no longer ignore the situation as Evergrande's troubles threatened to spill over into the broader economy. They intervened, issuing orders for the company to address its debt issues and temporarily prohibiting it from selling properties to raise funds, further accelerating the company's downfall. Evergrande, in a bid to shore up its finances, embarked on a mission to sell off non-core assets. Some of its stake in the once promising electric vehicle subsidiary was on the chopping block, along with various other divestitures. The specter of Evergrande's potential collapse loomed large over the real estate market. The company's extensive reach and interconnectedness with other businesses and financial institutions meant that the consequences of its downfall could be far-reaching and unpredictable. As the months passed, Evergrande engaged in high-stakes negotiations with its creditors. The goal was to restructure its debt and avoid the dreaded outcome of full-scale financial collapse. The initial step for the court would be to select a liquidator who will probably assume control of the company's management. The more significant challenge in the long run is determining how to divide the assets. As the liabilities of $333 billion surpass its assets of $242 billion, most of which are still located in mainland China. So the future of Evergrande, the world's most heavily indebted property developer, depends on Chinese authorities acknowledging a Hong Kong court decision for the company's dissolution. Overseas creditors of Evergrande anticipate the liquidator, Alvarez and Marsal, to propose a new plan to restructure the debt before resorting to dissolution. If mainland courts recognize the Hong Kong judgment, creditors will be able to seize assets in mainland China. However, this process could take several years and may face opposition from mainland creditors. The discussions about restructuring and the potential dissolution of Evergrande will require close communication with authorities in Beijing and Guangzhou, where the company is located. We will of course keep you informed as this story continues. In recent times, there has been a noticeable trend among Chinese workers to accept jobs that offer lower wages than what they are used to. This is attributed to the slowing economy and reduced job prospects. Migrant workers, in particular, are facing a significant decline in wages, although they are not included in the government's urban unemployment rate. The resulting decrease in wage growth and prevalence of underemployment has led to widespread dissatisfaction and a decrease in consumer confidence in China. It remains uncertain whether the measures implemented by the Chinese government, such as reducing interest rates, will effectively restore optimism and stimulate increased employment opportunities. Global spending on the clean energy transition reached a remarkable $1.8 trillion in 2023, representing a 17% increase from the previous year. While this is a significant achievement, it is important to acknowledge that it falls short of what is truly necessary to achieve net zero emissions. According to BNEF, investments in clean technology will need to more than double in order to reach this crucial goal. China remains at the forefront of clean energy spending, investing an astounding $676 billion in 2023. Additionally, the US, UK, and Europe also saw significant growth in clean energy investments, driven by various incentives and the rising demand for electric vehicles and renewable energy sources. China's recent decline in the stock market, resulting in a loss of $6 trillion, is shedding light on deeper challenges for President Xi Jinping's government. There is growing pessimism about the Chinese economy's outlook, despite the government's efforts to address the situation through measures like a bank reserve ratio cut and a rescue package. International and retail investors remain skeptical about the potential for a lasting recovery. This decline in the stock market serves as a public reminder of the issues impacting the real economy, such as falling house prices and increasing trade tensions. That's all for this week's episode. We sincerely hope you enjoyed it and found the information provided helpful. If you have any suggestions or would like to discuss the topics covered, please feel free to leave a comment below. We'll be back soon with a brand new episode. Thank you so much for watching, and we look forward to seeing you next week. Take care and goodbye.